We are joined by Bhise, who is the Financial Research Analyst at Financial Institutional Securities, joining in with us this afternoon. Samir, very good afternoon. Thank you so much for joining in with us. And Samir, let's just talk about the RBI changes, right? You cannot start any conversation right now without that topic, right? RBI changes in the risk weights. How are you seeing in terms of the bank loan growth? How do you see that shaping up? Could, from here on, what is the expectation there? Because in terms of the retail loan books was a bit broadly driven by stronger growth, while corporate loan book growth was something that took a backseat as well. So now, what is it that all these changes will indicate? Where do you see it headed?
Yeah, hi. So thank you for having me on the show. So I think obviously the talk of the environment right now is largely related to the changes that RBI has done. As we kind of indicated in our research last week, I think this should lead to some bit of growth moderation on the unsecured loans side, and that is where the regulations are directed towards. At the same time, I think I would want to highlight what RBI has done with respect to bank lending to NBFCs. I think that is a far-reaching and comes slight bit of a surprise versus just the risk weight changes. Risk weight changes had been talked for some time now. Finally, they have been put into place. Expect moderation on the unsecured side, more so with respect to some of the fintech-led originations. We expect some bit of a moderation on that side. At the same time, we think that over the next 6 to 12 months, as these changes play out, as we emerge on the other side of this impact settling down, it would keep some of the well-capitalized people who have been doing this product for a long period of time, these players to emerge stronger. This was a space which was attracting attention and competition from a lot of new players, smaller players. We expect some of that to kind of slow down and expect the larger guys to benefit, but that will only happen over a 12 to 18 months period. At the same time, usually when we see that a product which has seen significant growth for a slightly longer period of time come to a abrupt, I won't call a halt, but bit of a moderation, you might see some bit of inch up in delinquencies and recognized stress, because credit gets tighter, and which is what leads to some of the borderline customers not being able to kind of live up to their repayments. We need to see how big an impact is this, but I think RBI is being proactive here, and they gave enough time for everyone in the system to kind of gear up to these changes. So all in all, I would expect from a medium to good longer term, this is a welcome step. I would more kind of spend more time on how bank lending to NBFC moves, because NBFCs have been a big source of demand for corporate credit as we came out of COVID. Naturally, they need to diversify away from banks to that extent. Also, given the risk weight changes, our sense is that there could be some inch up in borrowing costs of some of the larger NBFCs by around 10 to 15 basis points on the bank loan side, which could either be offset by higher pricing on loans or moving away to bond markets.
Okay. Somit here joining into the conversation. So, because of this new regulations, we all know that the CET1 ratio, the tier 1 capital of banks and BFCs are expected to come down. But as per your analysis, which is the private bank which would be most impacted, which is the PSU bank which would be most impacted, and which is the NBFC which would get most impacted because of this?
So I think one needs to see this impact in context of what is the actual capital adequacy where these larger guys are sitting on. I mean, it is natural that players who are sizable in this product will get impacted to a certain extent. You asked me about names. We've put out that larger players, say HDFC, ICICI, will have a 70-75 basis points impact on CET1. And NBFCs, obviously Bajaj Finance is a large player, but they have ample capital. Recently they have raised equity capital as well. So there would be some impact on them as well. Among smaller players, Poonawalla FinCorp, but even there the capital adequacy is 40% plus. So doesn't change anything from a leverage perspective, or neither of these players are anyone on the borderline with respect to tier 1 regulation. But yes, these are the level of impacts that we can see on some of these larger players in the unsecured market.
When it comes to PSU Bank, the consensus view is that most of them would have to resort to a fundraise given that they already had a lower CET1 ratio. Would you concur to that? And as per you, which is the PSU bank which would need fundraising at most going forward?
So I think unlike what has been happening in the last, say, 5 to 6 years when PSU banks were not raising external capital, all through last 12 to 15 months, you have seen them raise capital from external sources, which is the public markets. That's a welcome change. PSU banks had recently entered this play in a more meaningful manner. So unlike some of the private sector banks or NBFCs where these are sizable proportions of the overall loan book, that is not the case with public sector banks, except say a SBI, wherein unsecured is slightly on the higher side versus other public sector banks. So I think that would be the name to look out for. But even there, that given that it is SBI, I don't think there is a worry as such. But yeah, given that they are a large player in unsecured business, there will be bit of an impact on CapAd.
Right, Samir, just want to know in terms of by when do you expect corporate loan books to expand? The government capex is on a line, but the commentary in the market does not give any strong signs for that. So, what is your view on this in terms of that?
Yeah, our view as a house, I think we believe that private sector capex is more post elections, where many corporates would have greater visibility on how the policy direction is going to shape up. At the same time, we need to understand that the entire manufacturing revival is helping the economy and it's positive. What we are awaiting is some of the large capex-led sectors which actually need more credit contribution that needs to revive or come back in a big way. I think that is more likely to happen post elections. We expect corporate credit to grow at similar pace where it has been growing right now. So do not expect meaningful changes over say FY24, more towards second half of F25, where we'll have further clarity on this.
Right, Samir, thank you so much for joining in with us this afternoon on ET Now, talking to us about the financial space as well. Thank you so much, Samir, for joining in with us.